In this video, we will discuss capital structure theory. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently chair of accounting and financial management at the Graduate School of the University of Maryland's University College. During the 1950s and 1960s, Modigliani and Miller developed capital structure theory. The objective of capital structure theory is to determine what capital structure, i.e. mix of debt, equity, preferred stock, and other forms of financing, will minimize the cost of capital for a firm and therefore maximize its stock price. Modigliani and Miller both won the Nobel Prize for these efforts, although in different years, 85 and 90. The objective of capital structure theory is to find the correct mix of financing that will maximize the stock price. This is the same thing as minimizing the weighted average cost of capital or the cost of financing for the firm. If we consider a very simple firm with only debt and equity financing, then WACC, the weighted average cost of capital, has this equation where the fraction financed with debt plus the fraction financed with equity adds up to 1. KD is the cost of debt, KS is the cost of equity, and since interest payments on debt may be written off on corporate taxes, the KD cost of debt is corrected by a 1 minus TC, where TC is the corporate tax rate. In science, it is common to start with very simple but very unrealistic assumptions to try and understand a complex problem. Gradually, complexity is then added to the problem. A common joke is to consider starting with a spherical cow. When Modigliani and Miller tried to understand capital structure, they started with a fairy tale world with no taxes, no brokerage costs, and no bankruptcy costs. A world with complete transparency of information and everyone paying the exact same interest rates. This is clearly unrealistic, but then you can gradually add the complexity and figure out how the complexity affects the model. If we start in this world, then Modigliani and Miller found that capital structure theory doesn't matter. It doesn't matter how much debt a firm has, how much equity financing it has, or any other type of financing they engage in. No matter what the firm does, the value of the firm is the same. For example, the value of a leveraged firm equals the value of an unleveraged firm. So what creates complexity and what changes the value of the firm is everything that is left out. So now we can start adding a few levels of complexity, consider the simple model, but then add merely corporate taxes. In most countries with corporate taxes, the interest that the firm pays on its debt is tax deductible on the corporate tax rates, and Modigliani and Miller found this simple equation. The value of the leveraged firm is now the value of the unleveraged firm plus the corporate tax rate times the amount of debt financing the firm engages in. Note the correspondence principle. If the TC, the corporate tax rate, goes to 0, we return to the previous equation. So each time we add complexity, we should note that if you take away whatever the complex object is, in this case, corporate tax rates, we should return to the simple equation of value of leveraged firm equals value of unleveraged firm. So now, if we only add the complexity of corporate tax rates, we find the more debt the firm adds, the more valuable it is, because as equity financing goes down and debt financing goes up, the firm pays lower and lower taxes. So under this unrealistic situation, a firm would want to have no equity and 100% debt financing. That would be optimal. This is clearly not realistic because if you have close to 100% debt financing, your probability of bankruptcy becomes quite high. Consider a company that is initially 100% equity finance and decides to refinance with 50% equity and 50% debt. If the unleveraged value of the firm is $100 million and the firm is subject to a 40% corporate tax rate, then according to the MM model with corporate taxes, what will the new leverage value of the firm be? So initially we have 100% equity, then we go to 50% equity and 50% debt financing. As a result of this additional $50 million in debt financing, our firm increases in value to 100 plus 0.4 times 50, or 20 to $120 million. Note again, the higher the corporate tax rate is, the more valuable the debt financing is. If we were to graph out this situation, showing the value of a leverage versus an unleveraged firm versus debt, again, here is the value of the unleveraged firm at 100 million, and as the percentage of that 100 million financed with debt increases all the way up to 100, the value of the leverage firm increases, in this case up to $140 million, since under this example we were again subject to a 40% corporate tax rate. If on top of corporate taxes, personal taxes on both debt and equity income are added, the MM model for the valuation of a corporation becomes this somewhat complex equation. The value of a leveraged firm equals the value of an unleveraged firm plus 1 minus the corporate tax rate times 1 minus the personal tax rate on equity income, also known as capital gains, divided by 1 minus the personal tax rate on interest, altogether times D, the amount of debt that the firm finances with. When looking at a complex equation like this, it is good as a check to use the correspondence principle, meaning in this case, if TS and TD, the tax rate on both capital gains income and interest income, go to 0, will this return to our previous equation? So if both of these terms go to 0, we get a 1 here, a 1 here, and we have a 1 minus the corporate tax rates. The 1's cancel out, and we just end up with the corporate tax rate times the dollar amount of debt. So we have our previous equation for MM with corporate taxes. It is also good to understand how the value of the leverage firm changes with each of these variables. We showed earlier that as the corporate tax rate goes up, the value of the leverage firm goes up as we have debt. So therefore, organizations that issue debt, like commercial banks, would tend to prefer a high corporate tax rate. If we look instead at the tax rate on individual taxes on capital gains, as this goes up, well, we have a negative and another negative making a positive. So just like with the corporate tax rate on debt, interest income, we see that as the personal tax rate on capital gains goes up, the value of the leverage firm goes up with the increasing amount of debt. This would be since individuals, since this is a personal tax rate, are not going to want to buy equities if that personal tax rate on capital gains go up, and instead will buy debt. Therefore, the value of the debt to a firm will increase. If the individual tax rate on interest income, on the other hand, goes up, we have a 1 minus this, so as this term goes up, this becomes smaller, so 1 over it becomes bigger, and we have a negative in front of that, which means this term will become smaller. So as the personal tax rate on interest income goes up, then the value of debt financing to a firm will in fact go down, since individuals then will not want to buy debt. We can do a numerical example of this equation. So consider again a company with initially 100% equity financing decides to refinance with 50% equity and 50% debt. Once again, the unleveraged value of the firm is $100 million, and we will say that the average investor in the firm is subject to a 40% tax rate on interest, but only a 20% tax rates on equity income or capital gains. And using the MM model with corporate taxes and personal tax rates, we ask, what is the new leveraged value of the firm? So we have $100 million. We have a 40% tax rate, again, on corporate income. We have a 20% tax rate on personal capital gains and a 40% tax rate on personal interest received, times $50 million in debt financing for the firm. So the firm is again going from initially 100% equity financing to 50% debt and 50% equity. This rather complex equation here turns into a 0.2, and we end up with the leverage value of the firm increases from 100 million to 110 million, not as much as it did under the previous situation. What about if we add the possibility of bankruptcy? So in the case of bankruptcy, a firm's debt holders are not going to be paid off, so they're going to be more worried about investing in debt. Therefore, as the firm increases its debt financing, they will become more and more worried, and investing in the firm will become more and more risky. And now we will examine how inputting this into the MM equation will affect its valuation. So again, we have a firm that's initially financed with 100% equity, and now we're going to decrease the amount of equity and increase the amount of debt. Well, as the equity ratio is shifted towards debt, again, the firm is going to become more risky. But initially, since debt is cheaper financing than equity, the weighted average cost of capital should become cheaper. The value of the firm should go up. But then as we increase more and more debt, there's going to be a point where the risk of debt financing outweighs the advantage of cheaper debt financing, and then the cost of capital of the firm will go up and the value of the firm will go down. In this graph, we look at the weighted average cost of capital, the cost of debt financing, the cost of equity financing, all versus the debt over assets ratio. So here we have the debt over assets ratio. Here we have the cost of each of these components. So when debt over assets is 0, in red, here we have the interest rate on the firm. It will be the lowest when there's very little debt, since there's very little risk of bankruptcy. And when debt over assets is 0, the cost of equity capital, shown in green, is the total WACC, shown in blue, since there is no interest financing. Gradually, as you increase debt, well, as risk goes up, banks are going to charge the firm more and more in interest, and then the WACC of the firm will diverge downward away from the cost of equity as we've added more and more interest financing, debt financing versus equity. At a certain point, here around 30%, we find that WACC is minimized and then starts to go back up. This is the point at which the riskiness of adding more and more debt and increasing the possibility of bankruptcy starts to outweigh the advantages of cheap debt financing. So in this example, this would be the optimal mix, or the optimal weighted average cost of capital would be around 30% debt to assets and 70% equity to assets, which will also be the point that will, in fact, maximize the stock price. Here we show, again, the same type of WACC equation, and it becomes minimized around 30% debt. But now we also show the value of the firm, and we show the point where the blue line WACC is the minimum, is the point where the red line, the value of the firm, is the maximum. The cheapest financing gives you the highest valuation for a company. How these graphs were derived is going to be from equations such as this. The value of a company can be calculated using the constant growth stock model, and in this case, the free cash flow discount model, where for a constant growth stock, the value of the firm is the firm's free cash flows times 1 plus the growth rate divided by WACC minus the growth rate. And in WACC, we can embed the riskiness of the firm by using the Hamada equation. So as an numerical example, we consider a company with a WACC of 10%, an expected growth rate of 6%, 10 here, 6% here, and an expected free cash flow of 100 million, then the value of the firm will be $250 million. If the company has outstanding debt of 100 million, then the value of the equity of the firm, this V is now the total value of the firm, so the value of the equity firm is going to be the 250 million total value minus 100 million debt value, so 150 million in equity. And then you would have to divide by the number of shares to get the value per share. The structure of the banking industry in the United States is somewhat unique compared to the rest of the world due to the Glass-Steagall laws that were passed in 1933, which separated investment and commercial banking. Investment banks sell stocks, commercial banks make loans. We showed earlier the equation of the value of the firm as a function of corporate tax rates and personal tax rates on both debt and equity. And we noted that as corporate tax rates increase, the companies have a stronger incentive to finance their firms with debt. Therefore, commercial banks, which were separated under Glass-Steagall from investment banks, are going to like a high corporate tax rates. So commercial banks, as noted, like high corporate tax rates. Investment banks, on the other hand, would like low corporate tax rates. Similarly, as we discussed in the complex MM equation, commercial banks like high dividend taxes and investment banks like low dividend taxes. The equation we used to embed risk into the previous WACC equation to make the graphs showing that as the possibility of bankruptcy increased, the value of the firm went down, was the Hamada equation. The effect of increasing debt on equity can be developed by this equation, which was created by Robert Hamada at the University of Chicago around 1970. The beta of a leveraged firm, which is the risk measurement of the firm, is the beta of an unleveraged firm times 1 plus 1 minus the corporate tax rate times debt over equity in dollars financed for the firm. So if debt is 0, beta unleveraged equals beta leveraged. 1 minus corporate TC is going to be a positive number. So as debt increases, the beta of a leveraged firm increases relative to the beta of an unleveraged firm. More and more debt, more and more risk. As an example, we could consider a firm subject to a corporate tax rate of 40%, financed with 70% equity and 30% debt. If the unleveraged beta for the firm is 1.1, its leveraged beta is going to be 1 plus 1 minus 0.4 the corporate tax rate, or 0.6, times 30% debt over 70% equity over 3 sevens. 1.1 times this is 1.4, and the beta leveraged is in fact 1.4, higher risk than the unleveraged firm. Another topic commonly discussed with Modigliani and Miller is signaling theory. Managers, of course, know more about a firm than the general public, and they generally own stock or have stock options in the firm they manage. They therefore may do what is in the best interest of them, the managers, versus the general stock owning public. A new stock issue spreads potential profits or losses among investors, so for a well-established firm, it is generally considered a negative signal and the stock firms may drop. The reason for this is if a manager thinks the firm isn't doing too well, they might issue new stock to, shall we say, spread the pain among new investors. On the other hand, a new debt issue will increase the return on equity for a profitable firm and is considered a positive signal. This is considered hoarding the wealth, since if the management thinks the firm is going to do very well, they will want to have fewer stockholders to spread their profits among, and they might in fact borrow debt, buy back stock, and hoard the wealth to themselves and the other insiders at the firm. I thank you for watching this video on capital structure theory.